It was a decision that was welcomed by many borrowers. For the first time, Kenya had moved to cap interest rates charged on credit by commercial banks. The law setting a ceiling of not more than 4% charge above the central bank rate on loans. Months later, both the lenders and borrowers are being impacted on by this move by the president.
The Act has forced banks to turn away customers that do not fit into what is prescribed by the law. In other words, if it doesn't make financial sense, then the bank will not extend credit.
The impact of this law has actually shifted from being how it affects the bank's performance, profitability and all that, and has shifted to the real economy, where it's affecting households, as well as other markets, as well as the broader economy.
The banking industry maintains that they share the government's goal to make affordable finance more accessible, but the Act in its current form is not fit for purpose to deliver that goal. The bankers say that the sector is already affected by declining credit growth are households, trade and manufacturing, building and construction, which account to 70% of credit borrowers.
Unless if the law is amended to ensure that the negative consequences that are becoming apparent right now are addressed, I think we may continue seeing the continued shrinkage of availability of credit to the very vulnerable segments of the borrowing public.
Already major commercial banks have factored in the impact of the changes in the law in their full-year reports of 2016. The banks realized depressed borrowing as well as a rise in non-performing loans in the last quarter of the year under review. The reduction in the amount of loans issued has worried both the Central Bank of Kenya and the government, as acknowledged by President Uhuru Kenyatta in his State of the Nation address. KBA says the banking industry hopes to re-engage with the National Treasury, the Central Bank and Parliament to rethink the decision to cap interest rate. Mumbi Waroi, JKL.